in some of the homework questions is they do this on December 31, not January 1. So if it was December 31 and it was 3 years in arrears, well then that is December of 15, 14, and 13. Okay? So it's a total of 3 years, not. You guys, I'm stopping you out the door. Did I? You must have. Sorry. You did. Something. You did.
Might have been
you guys. All right. Watch out for the date. This one is 3 years in arrears, starting January 1, so that was 14, 13, and 12. If it was December 31 of 15, 15, 14, and 13. Okay? Watch out for the dates and the time. Okay? So anyway, we're doing what's in arrears because they have not yet paid the dividends. And you'll notice all we're doing is allocating from one section of shareholders' equity into another. That's all we're doing. Okay? So then, that gives us the adjusted shareholders' equity of our subsidiary of Sherri. That's the adjusted. And then what we have to do is figure out how much does the parent get. And the parent invested 90% in the preferred shares, so they're entitled to 90% of that adjusted income, or sorry, adjusted equity of that belongs to the preferred shareholders. Now, in some of the questions, say that the parent owned nothing in the preferred shares. Well, that's fine. You would still do exactly the same steps, but at this point, well, if there is 0% ownership in the preferred shares, this percentage is going to be 0. That's not going to change, right? 0 is 0. We use 90 here because 90 is how much they owned. Okay? So watch out for that in an exam situation. Watch out for that in the homework. In some cases, you know, I was doing some of my solutions, I was wondering, where the heck is the preferred? Well, the preferred was 0. They did that on purpose. So watch out for that. Okay? We used 100% here because this is what we did for consolidations. We have 60%, we bumped it up to 100. So this is exactly what we've done in Module 4. So leave it at 100%. Okay? Then what we did was our step 1, but we did it first for the preferred shareholders. So we would do exactly what we do with our acquisition differential. We put our purchase price. Well, in this case, it was at 90% or $40,000. Okay? If it was 0, it's 0, right? So then this whole thing would be 0. But in this case, it was at 90. Then we had the shareholders' equity applicable to the preferred, which was the 32.4, and that gave us our acquisition differential that would ultimately get charged to retained earnings. Okay, debit to retained earnings. Then we did what we normally did in Module 4. We went ahead and we did our acquisition differential and now this is on the common shareholders, and that's what we did in Module 4. We just never promoted it as just on the common shareholders, but that's exactly what you did in Module 4. So we did our purchase price and we bumped it up to 100. These are consolidations. Consolidations, we bump it up to 100. Under our joint venture, which is what we looked at also last day, in the joint venture, did we do any bump up? No. Even if you had 80% interest in the joint venture, under the equity method, we left it at 80%. We never bump it up under joint ventures. So don't do that on the final exam. Joint ventures, leave it at the percentage of ownership. Okay? Even if it's 80, 60, 20, whatever. Leave it at that percentage of ownership. Okay? Then, so anyway, we bumped it up. This is consolidations, parent and sub. So we take off the book value, the net assets. Remember, the net assets is common shares and retained earnings, which is what we did up here, right? At 100%. This hasn't changed. That gives us an acquisition differential of 6. Then we found out in the notes, it said that 4,000 of it was pertaining to equipment, leaving us with $2,000 goodwill. Okay. Then what we did was step 2, which was the amortization of the acquisition differential. That hasn't changed. We took our 4,000 and our 2,000 and we amortized it. When we amortize, that's an income statement item, right? That's amortization expense, loosely, right? We did that. No worries. I'll blame you later. Okay. So this is our income statement. The balance goes onto our balance sheet and in our NCI. Okay, so this is what we did last day. Then we went ahead and we did step 3. And step 3 is our intercompany transactions. This is consolidation, so it's intercompany transactions on dividends, sales, cost of goods sold, other revenues and expenses, and intercompany loans, accounts payable, accounts receivable. In addition to that, consolidations, we also have to look at intercompany inventory, land, depreciable capital assets. When we did the equity method, that is joint ventures, equity method, IFRS, we didn't have to worry about intercompany sales, intercompany other revenues and expenses, intercompany loans, because intercompany loans, for example, involves really what 2 accounts, roughly? But an intercompany loan means we're dealing with a receivable and a payable. And so we don't use those because we only are dealing with the investment account and the investment income, okay? So there is no balance sheet column, there is no intercompany sales that we worry about for joint ventures because it's the equity method. Okay? Steps are similar, but we don't use those in that concept. But consolidations, we do need them. Okay, so we have to look at what we did with the dividends. So the dividends, if you recall, they were declared at $15,000. This is the subs dividends. Okay, the subs dividends, they declared $15,000, and now we have to allocate between preferred and common. So we do the preferred first. So what goes to the preferred? Well, it's the dividends that were in arrears. We do those ones, and that's why I was reinforcing our time period. Our time period was January 1st of 15. When we pay dividends, when we're doing our financial statements, when we're doing the income statement is prepared when? On December 31st. So we see here, we have 3 years in arrears because this ending date is December 31st of 14, right? This is December 31st of 14. The line underneath represents December 31 of 15, our current year. So that's why you have to really be careful of the dates. What's in arrears? Well, up to January 1 meant the stuff in the past. December 31 of this year is our current. Okay? So be aware of that. In this case, 4 years worth of dividends. Okay? So when we added the total amount of dividends eligible for the preferred shareholders, that amounted to $6,000. That $6,000 comes off the total amount of dividends that was declared. That comes off the total amount that was declared. But for the parent's point of view, we have to eliminate those intercompany transactions. So we have to take the $6,000 and take 90% of those. So what we're going to eliminate, what we're going to see in a moment, is we're going to eliminate $5,400 of that, because that's how much we actually received from the subsidiary. 90% of the dividends going to the preferred shareholders. The remaining 600 goes to somebody else, okay? But 6,000 comes off, meaning the common shareholders get $9,000 worth of dividends. 9,000 at 100%, all the common shareholders. But when we look at this for the purpose of eliminating the dividends, we pull our percentage of ownership, and we're entitled to take off 5,400 or eliminate 5,400. Okay? So in total, we're taking off 10,800. That is, Port or the parent received $5,400 in dividends for the preferred shares and $5,400 on the common shares. So this is what we looked at last day. So we will eliminate 10,800 from the income statement. Okay, we're going to eliminate that from the income statement. Okay. Then, do I want to do this one? Guess I will. Okay. That one. Okay. Okay, so now what we need to do is continue on with our intercompany transactions. And we can see that we had intercompany sales and cost of goods sold. Point number 4, Port had $25,000 in sales to Sherri. So that's what we see right here. Parent to sub, that's downstream, 25,000 goes to, that will need to be eliminated. We also need to look at sub to parent, which is an upstream. And in the question here, it doesn't say anything between Sherri to Port. Sherri to Port. So that would be 0. Okay. Then we need to take a look at intercompany other revenues and expenses. Other revenues and expenses, and in the question, there was nothing in here that suggested any other management fees or anything like that. So normally I would put down parent to sub. I guess I will do it. And sub to parent, those are 0. Okay. Then we had our intercompany loans. This would be accounts receivable, accounts payable, parent to sub, and sub to parent. And we're looking for any sort of amounts owing to the other company. And we see we have the sales, there's the gross profit, inventory remained unsold, and that's it. That means there was no intercompany loans. Okay? This is consolidations. This is what we saw in Module 4. Okay. Comments, guys? Are we good? Okay. Next. Next, what we want to do is our additional intercompany transactions. And these intercompany transactions refer to what?
Inventory, gross profit.
Right. Inventory, the gross profit.
Depreciable capital assets.
Depreciable capital assets. Good. And our
gain and losses on land.
And our land. Yeah. Okay, good. So we're looking at inventory, land, depreciable capital assets, and yes, we're really looking at the profit, the gains and losses. Okay. So we're going to set up our columns. We're going to have a balance sheet column, and our balance sheet is on December 31 of 15. In other words, this is at the end, right? End period. We're also going to have an income statement section. what do we find in the income statement section? We have the for tax. We will have tax expense, and is that 20%? Point number 6, guys? Is that right?
Yeah.
20%. And then we have after tax. Okay. Yeah. Okay. We'll do that. So we'll start off by looking at our inventory. Inventory and our gross profit. In other words, we need to eliminate. Okay, that's why we're doing this. We're looking at those things that we need to eliminate or make adjustments to when we do our consolidations. Okay, so we'll start off with our parent to sub, which is downstream, and we go through the motions. We'll have potentially we have beginning inventory. We treat it like an error. Beginning inventory is too much. It's too high, meaning cost of goods sold is too high. Good. Net income is too low. And when we fix it upon consolidation, we will add it back. Beginning inventory is on what date? January 1. My balance sheet's on December 31. So we will never see an amount in the beginning inventory. It will never be adjusted on the balance sheet because it's the wrong date. Okay. In this case, we don't have any beginning inventory, but if we did, we would put it in the income statement columns. Okay. Next, we will have ending inventory. It's treated like an error, so ending inventory is considered too high. Cost of goods sold would be considered too low. Net income would be considered too high. And then when we fix it, we will get rid of it. Okay? We will get rid of it. All right, what do we know? We have point number 4. Point number 4 says we have sales. Is it sales that we need? No, we need to convert our sales into gross profit. Okay, we need to convert it into gross profit. So we have $25,000 in sales, but we need to convert it into gross profit, and we do that by doing what? Yes, 50% gross profit. Again, on your midterm, some of you, one of the intercompany transactions said 70% was the cost of the inventory. And some of you put 70% here, okay? Reinforcing, we are focusing on eliminating gross profit, okay? So don't take cost of goods sold, convert that into gross profit. So if it's 70% cost, it is 30% gross profit, okay? So be careful of that. Anyway, so we have 12,500, which is the gross profit. Now, in your module 4, the 12,500 was typical, was the number that you saw in module 4 for the midterm. Why did we, on the midterm, take the 12,500? That was what the other entity held, right? The purpose of this is to eliminate those activities that are still being held by the other entity. In this case, being held by the sub. So if the sub still holds on to that inventory, that's when we get rid of it. That's when we eliminate it. And in this case, Mustafa, you're saying, this is saying that 100% of that transaction is still being held by the sub. Okay? And that's what we would eliminate. But in this question, did the sub keep 100% of it? No, it says they kept 40. 40 was unsold. We could very easily, and I keep on saying we, I'm the only one teaching this course this semester during the daytime. I could instead put down what? 60% was sold, right? 60% was sold. But what we're trying to eliminate is what is being held, kept, unsold. Okay? So watch out for that. If we say 60% is sold, that's fine. Remember when we talked about land in Module 4? Well, we got rid of the land because it was not sold. When it was sold, then those gains and losses were fine. Okay? So watch out for that. We're looking for something that says it remains what's left unsold. Okay? Watch out for that. I need some oars. Okay, so it's the 12,500 in the gross profit, but we're gonna multiply by the 40% because that is what is left, what is unsold, okay? That means that's too much, we gotta get rid of it, okay? That will give us $5,000. That is left, okay? Now, yeah, go ahead.
Do we do the ownership on this too, or no?
Okay, good point. Now, this is consolidations, right? In consolidations, there's the implied value of ownership of 100%. And I did mention it first period, but thank you for mentioning it. So, when we consolidate, even if we have 60%, what we do is we keep it at 100% ownership, which is why we calculate our favorite TV show called NCI. Okay? So, when we do consolidations, we leave it at 100% ownership. So in other words, we leave it at the full 5,000. If this were a joint venture means for IFRS they're following which method? Equity. And that's when you adjust it for the ownership. When you do the equity method. Okay? So far so good? Okay. So we leave it at the full 5,000. This is on what date? December 31. So guess what? 5,000 will go on the December 31 balance sheet. Ending is on the December 31. This 5,000 represents what account on the balance sheet? Balance sheet. This is your ending inventory. Inventory is on your balance sheet. And this is like your error. Ending inventory is considered too high. The next column, we still put that 5,000, but now this is your income statement account. That is your cost of goods sold. Okay, that's your cost of goods sold. And cost of goods sold is considered too low. 20% of it gives us 1,000. This represents what account? On the income statement. The tax expense, good. The tax expense. Well, what's happening? Well, because cost of goods sold is considered too low, it means we have too much net income. If we have too much net income, how does that affect our tax? Too much, which is a debit. Okay, we will fix these. We've seen that in Module 4. Okay. The difference of 4,000 is our after-tax amount, which goes to the calculation on our income statement, the calculation of consolidated net income. Okay. So far, so good? Okay. This is Module 4, but reinforcing it. for Module 5. Okay, one last thing that we need to include in here is our what? Deferred tax. So we have deferred tax. Deferred tax is found on which financial statement? Balance sheet. So we're gonna put it into this column. Now, which account is deferred tax related to? The tax expense. So which number do I grab here for the balance sheet? The tax expense of 1,000. Why? Because this was done at the end. So when we did this in Module 4, we always grabbed the balance on December 30, or at the end of the period, so December 31, because that is the date of our balance sheet. So, which is why we never grabbed the beginning, right? Because beginning is January 1, balance sheet's on December 31. So always grab your ending balance, okay? And that's $1,000. This is being fixed, so how do I fix my deferred tax? Debit. Because if I'm debiting deferred tax, I'm crediting the tax expense. In other words, I'm prepaying my taxes, okay? If you will, we're prepaying. So far, so good?
If there's like a tax expense for beginning inventory, would you
Never
count
touch it, not for deferred tax.
Oh, no.
No, because beginning's on January 1, this is on December 31, which is the date of our balance. No, because January 1 is not December 31. Yeah, never do the beginning, it's always at the end, ending balance, okay? All right, next. Now we do step 4, which is the calculation of consolidated net income. And the steps here are very similar to what we've done in Module 4. So what did we do in Module 4 when we did the calculation of consolidated net income? We first started off with whom? Our parents. So we're gonna start the same way, net income of Port, who's our parent, and that was for $40,350. Is that right? Making sure I'm looking at the right line. Okay, $40,350. What was wrong with this net income? It includes what? The dividends. So we have to get rid of the dividends. So less dividends from whom? Right, from our sub, which is Sherri. Okay, we're getting rid of Sherri's dividends. Well, how much did we calculate the dividends to be? Well, 15 was the total. How much is applicable to the parent? 54 and 54, 10,800. Right? What went to the preferred shareholders? We own 90% of it, and then the remaining 60% went to the common shareholders. So don't forget that. That's why we did this step in step 3. Are we okay with the 10,008, guys? Okay. So 10,008. Then we have to do our intercompany transactions, and this is only on those between that involves inventory, land, and depreciable capital assets. Yep.
For step 3, there's the equipment.
Oh, yeah.
There's equipment?
Yeah.
Number 1, depreciation.
Right,
First
but that
one.
was through the acquisition differential and the amortization. Yeah, there was no transfer. Remember, there's no transfer between Sherri and Port. This is only on the acquisition differential. Yeah. Okay, good. Yeah, it's a good comment. I mean, okay, but yeah, that's the reason why it's not there, because it only goes to the acquisition differential. If it was between the parent and sub, then absolutely. goes right here. All right, so we'll first start with inventory. And inventory, I guess I should do it this way. The only thing we had was the ending inventory, right? Go back, we take a look. We had our ending inventory here. So ending inventory, I want to make sure I'm doing the right line, is considered too high. Cost of goods sold is considered too low. Net income is considered too high. And now when we want to fix it, now we're gonna fix it, we're gonna subtract it. How much of the inventory are we going to take? Remember, this is our income statement, right? This is our income, I got it right here, it's right in front of Doug. It's gonna be the 4,000, right? Because this is the income statement, and we take the after tax. Okay? And so we'll take the 4,000. So far so good? Okay. Now we have adjusted net income of port. That's 25,550. How we doing? Okay. Next, we have net income of Sherri, correct? And that is our sub. And the net income is 25,000. So we take the 25,000 like we normally do, but this is where we have to do a slight change.
Yes.
Okay. Remember, we have been introduced to a new concept. The new concept is the preferred shares, the preferred shareholders. Now, what we need to do is we need to take that net income and split it between the preferred shareholders and the common shareholders. Okay? We need to allocate it so we know who gets what. The reason why we allocate it is because, allocate the net income, is because when does the board of directors declare a dividend? When do they declare a dividend? When the company has a what? A net income, right? When a company has a net income, then the board typically declares dividends. How much are they declaring? Potentially, they are allowed to declare 100% of the net income. They don't, but that's why they are declaring dividends in the first place, is because they've earned a net income, and the net income is the basis. That's the maximum amount of dividends they typically can declare, typically. Okay? So what we're trying to do here is allocate it between the owners and the non-owners. Okay? Well, you notice I'm scratching my head. How do we allocate it? Well, what do we know about the preferred shareholders and dividends? In this question, what do we know about the preferred shareholders that relate to dividends? Yeah, they are cumulative dividends, right? They are $5 cumulative. So to allocate the net income, well, the preferred shareholders are entitled to $5 per 300 preferred shares. That's $1,500. So out of this 25,000, the preferred shareholders are entitled to $1,500 of the net income. Okay? You'll notice I only took 1 year. Why 1 year? We're talking about
Current year.
net income, and we're talking about current year. Net income is from January to December, which is
1 year.
current or 1 year. So in other words, we don't touch what's in arrears because that's the past, that's retained earnings, okay? And you'll see that if you do the other homework questions, there is a retained earnings one in there, and you'll see that that's where it's treated there, okay? But we're only gonna focus on this question, okay? So, we're good with that 1,500? Okay, the remaining then goes to the common, that's 23,500. Okay, what's next? Net income, then we go plus or minus the amortization of the acquisition differential. Now, this step hasn't changed from what we did in module 4. So in other words, where was that? We see that the amortization of the acquisition differential totaled how much? Step 2, right? Was that 1,900, guys? So we will still take off the 1,900, but we need to allocate it. Well, when we did module 4, what type of shareholders did we have in module 4? The common. So that means nothing has changed, so we'll allocate the entire amortization and it will go to the common shareholders. Nothing ever will go to the preferred. Okay? It belongs to the common shareholders, the owners. Okay? Next, plus or minus the intercompany transactions, right? Between the sub and the parent. That is upstream. Okay? In this question, we see nothing, right? But if we did, well, we saw it over here, right? But again, when we did this in module 4, well, what type of shareholders benefited from this? It's only the common, never against the preferred. So I put a 0 here to reinforce the fact that a dollar amount would go here, but the dash indicating it will never go to preferred. So the amortization never goes to the preferred. The intercompany transactions, inventory, land, depreciable capital assets, will never go to the preferred. Only to the common. So far, so good? Okay, so now, what do I have here? Now we can calculate an adjusted net income of Sherri, which is our sub. So we'll just add our columns together. We have 1,500 for the preferred. We have 21,600 for the common. And is that 23,100 in total, guys?
Yeah.
Editors, is that right?
Yeah.
Okay. So this is what we did in module 4, right? We just had this column. All we did now was split it between common shareholders and preferred. And all we're seeing under the preferred are the 1 year's worth of dividends. Okay. The rest goes under common. So 15 plus the 21,600 gives us the 23,100. Okay, so far so good? Okay, now what do? Well, we calculate our consolidated net income. Consolidated net income is 48,650. Our last step for the calculation is to calculate or to allocate it or to attribute it to our parent, who is Port. Well, where did we start when we allocated or when we went attributed to the parent? We started with whom? The parent, right? So we're gonna grab the 25,550, and how much of that is the parent allowed? All of it, 100%. Good. What we did in module 4 was we grabbed the 23,100. But now what we do is, module 5, we're now gonna grab preferred and common. So we're gonna grab the preferred next and put down how much does the parent own of that? 90%, right? They invested 90% into the preferred shares. So we'll grab 90% of that. Are we okay with that, guys? That's how much they invested into the sub. Okay. Then we have 21,600. That's the common shares. This is module 4 now. And what do we know about what the parent owned in the sub? 60%. That's our 60% now. We okay with that, guys? Times 60%. And that should give us, is that 39,860? Believe, editors?
Yeah, that's what I
Yeah,
got.
okay, cool. Now we have to do our favorite TV show called NCI. Okay, we do NCI. Well, we go back to what we know. We start off with the 25,550. If 100% is owned by the parent, the non-controlling interest component is 0. Right? Then we go to the preferred. Well, 1,500. Well, if 90% is what the parent owns, then 10% is what everybody else owns, the non-controlling interest. Okay. Then we go to the 21,600. 60% is owned by the parent. Non-controlling is 40%. That should give us 8790. 48,650 is our consolidated net income. How are we doing? Okay. Comments, guys? Okay. Then the last thing, guys, to finish answering this question, again, you'll notice I've got step 5, 6, and 7 here. Potentially you could be asked that, but I think we've gone over the main points, the basic points for this component of the module. But here's our income statement. Solution again is up on Moodle, so double check it, maybe practice that, probably be a good idea. But consolidations, there's the parent, there's the sub, there's the intercompany sales that we are eliminating, 25,000. If we go down to cost of goods sold, one person's sales is the other person's cost of goods sold. You'll notice that's eliminated, right? So on the exam, module 4, some of you did the other way, you added it, or maybe that was intercompany loan, but still, it's got to be eliminated. So subtract them from both. Okay. Then next, dividend income, 10,800. We're eliminating the preferred dividends, the common dividends. It totals 10,800. And that's what we see right here. I split it out here, but that's the 10,800. So there aren't any dividends. All of them was from the sum. Okay. Cost of goods sold. Well, again, we talked about that cost of goods sold from the intercompany sale. And then we had our ending inventory. Through cost of goods sold was too small, meaning we have to add it back. Okay. It's too small, we have to add it back. Amortization. So, Hank, maybe now to address that initial concern, here is the parent, here's the sub, the acquisition differential. There's our $400 amortization expense that we now include in our income statement. Okay. Goodwill impairment of the 1,500. The goodwill impairment of the 1,500, we put it as a separate line item, typically. Okay, put it as a separate line item. There is no adjustments to selling and admin or to other expenses. The only other thing we had was the income tax expense, and that came from our income tax expense. The debit tax expense, meaning too high, it's an error, so that's why we are subtracting it. You notice I have on the solution, I think this is the one I have up on Moodle, That's why I put down ending inventory. It's relating to too much tax expense in the tax column. So we're subtracting it to get rid of it. So far, so good? Okay, that is it for today. What we'll be looking at Monday, it probably would be in your best interest to review it. It is not super hard, but it is something that we need to review.